for Friday's volatility. If your week's been trading sideways, well, let's break that range with the facts. Today's Thursday, September 18th, 2025, and this deep dive covers the key developments from yesterday. That's Wednesday, September 17th, 2025. Welcome, everyone. We're here to really cut through the noise of yesterday's global market movers, extracting those crucial insights you need to stay truly well-informed. It was a day absolutely packed with central bank action, some pretty wild commodity swings, and some fascinating regional shifts, too. Stuff that could have a direct impact on your strategy.
And that's exactly what we're aiming for today. Connecting these, well, seemingly disparate events for you. We're not just going to report what happened. We want to uncover the why behind the headlines and, critically, the so what now for your portfolio or maybe your business. We'll show you how global policies can ripple right through local markets, giving you, hopefully, a clearer picture of this whole interconnected financial landscape. Let's try and make these complex movements clear and actionable.
Okay, sounds good. Let's unpack this then, starting with what was arguably the biggest driver yesterday, the Federal Reserve's rate decision. Now, we saw a quarter-point cut, which, was largely anticipated, but that single dissenting voice within the FOMC, that immediately caught my eye. What's the significance there, and how did it shape the market's somewhat mixed reaction?
Yeah, you've hit on the crucial detail there. So while the Fed delivered its expected quarter-point cut, signaling a measured easing pace, that single dissent from within the Federal Open Market Committee is, well, it's incredibly telling. It's a subtle signal, but a powerful one, that there are differing opinions even among policymakers about the, let's say, optimal pace of easing. Hints at ongoing internal debates about inflation versus growth risks. And on the market side, well, U.S. large caps were pretty mixed. The S&P 500 only nudged up 0.10%.
It's barely moved.
Exactly. But the Dow outperformed quite a bit, rising 0.56%. Tech, though, was a touch softer. The Nasdaq actually slipped 0.03%.
Okay, and the bond market. How did that respond to the easing signal, especially with, that dissenting nuance?
The bond market reacted more directly, which is fascinating, actually. The 10-year Treasury yield dropped down to 4.009%,
Okay.
and the 2-year yield fell to 3.495%. Now, this move, importantly, it steepened the 2S10s curve, so that gap between shorter-term and longer-term yields widened out a bit. Normally, you'd think lower yields support growth equities, right, because borrowing costs decrease and future earnings are discounted less aggressively. But the mixed equity reaction tells us investors aren't just reacting to the cut itself. They're actively scrutinizing those underlying signals, the dissent, the cautious forward guidance. It indicates maybe a deeper skepticism about the economic path ahead.
So it's not quite the simple dovish Fed equals risk-on response this time around.
Exactly. It's more complicated than that.
Right. So while the Fed signals easing, the ripple effects are already being felt elsewhere. Energy markets, for instance. They had a particularly dramatic day, didn't they? We saw that EIA data indicating a sharp U.S. crude inventory drop, even despite this broader macro risk-off feeling.
Yeah.
What's the real story behind that drop? And what are the implications for global oil prices?
Oh, absolutely dramatic is the right word. Look, this wasn't just any draw. U.S. crude inventories fell by a massive 9.3 million barrels last week.
Wow.
Yeah, plummeting down to 415.4 million barrels. Now, what's really driving this, and this is the fascinating part, is that this huge draw was largely fueled by surging exports and record low net imports, meaning more U.S. crude is heading overseas. And even with some product builds, so inventories of things like diesel and heating oil rising by 4 million barrels, while gasoline stocks actually fell by 2.2 million. The sheer tightness in crude supply itself supported Brent crude. It held firm near, USD 67.88 per barrel. So this raises a really important question for you listening. How sustainable is this export-driven demand? What does it imply for global oil prices going forward? Especially if geopolitical tensions in key energy-producing regions flare up again, impacting supply chains or production.
Good point.
Yeah.
A lot to watch there. Okay, from black gold to actual gold, that also had a notable day. Initially hitting fresh highs, but then easing off a bit. What was behind that volatility? Was it just post-Fed profit-taking or maybe something more fundamental?
Yeah, gold truly put on a show yesterday. It initially hit an impressive record-breaking intraday high of USD 3,707.40 per ounce. That's a significant milestone.
Definitely.
However, right after tagging those fresh highs, we saw some predictable profit-taking kick in, especially after the Fed decision. That pulled bullion back to USD 3,658.25 per ounce, so down about 0.9% on the session. But what's particularly striking here is gold's incredible rally this year, up 39% year to date. It really is.
Yeah.
And this surge has been largely fueled by persistent central bank diversification away from the U.S. dollar, alongside just robust safe haven demand, particularly from lower real yields globally, that's bond yields after inflation. You even have Deutsche Bank raising its 2026 price forecast to a staggering USD 4,000 per ounce.
Wow, okay.
Which kind of puts this pullback into perspective, right? So while it was volatile, this could very well just be a healthy consolidation rather than a fundamental shift in gold's strong upward trend. But it definitely highlights the inherent swings you get when an asset reaches, uncharted territory.
Makes sense. Speaking of global ripples, we saw some really fascinating policy spillovers from the Fed's move that had immediate regional implications. Tell us about what happened with the Gulf central banks.
Yes, this is a classic example of that financial interconnectedness playing out in real time. Almost immediately following the Fed's decision, central banks right across the Gulf Cooperation Council, we're talking Saudi Arabia, UAE, Qatar, Bahrain, Kuwait, and Oman, they all mirrored the Fed's move, delivered 25 basis point cuts to their own policy rates. Now, why is this important? Well, most Gulf currencies are directly pegged to the U.S. dollar.
Right, the peg.
Exactly. So to maintain the stability of these pegs and just broader financial stability, they typically have to follow the Fed's lead. These synchronized cuts immediately eased regional borrowing costs, which is crucial for supporting their, ambitious economic diversification plans beyond oil, encouraging investment and growth. It's really a textbook response to preserve their currency regimes.
Got it. A direct and necessary link there. Okay, that's a great look at the big drivers. Now let's take a rapid-fire snapshot of how different markets reacted broadly yesterday, looking for any interesting connections or divergences.
Sure. So in equities, as we kind of touched on, U.S. large caps were mixed, tech a bit softer, suggesting maybe a rotation. Europe was largely unchanged overall, and Asia saw some profit-taking in earlier winners, but there were specific bright spots too.
Okay, and rates and credit, what was the picture there?
Well, the U.S. Treasury curve, it eased and steepened modestly post-Fed, reflecting those yield drops we talked about. Importantly, credit spreads, basically the extra yield investors want for holding corporate debt over safer government debt, they stayed relatively tight, which suggests, some underlying confidence in corporate health despite all the broader uncertainty swirling around.
Okay, interesting. And in the currency markets, how did the dollar fare against others?
The dollar softened up a bit. Against the euro, it moved to about USD 1.1894. And against the yen, it dropped roughly 0.5% to JPY 145.78. This weakening was largely down to those narrower rate differentials we saw after the Fed's cut. It just made dollar assets slightly less attractive relative to their counterparts.
Right, makes sense. For other commodities beyond crude and gold, any quick highlights?
Well, Brent crude, as we discussed, held pretty firm near that USD 67.88 per barrel level, really supported by those strong U.S. inventory draws. Gold, of course, faded off its record close, mostly due to that profit-taking we mentioned.
Got it. And finally, a quick check on the crypto space. Bitcoin.
Yeah, Bitcoin futures firmed up a little. They rose about 1.35% to USD 117,230. This seemed pretty much in line with lower yields and a generally improving, albeit maybe cautiously, risk tone across markets.
Okay, good overview. All right, let's zoom in now and dive a bit deeper into specific regions. Explore what really caught our eye yesterday beyond those major headlines, starting in the Americas with the U.S. economy. We know U.S. stocks churned after the Fed cut, Dow outperforming as investors rotated towards value, NASDAQ lagged. But what else was happening on the ground there? Anything significant?
Yeah, that stock rotation is definitely key, tells us about investor caution. But what's maybe truly interesting for the broader U.S. economy is that the housing market started flashing some early signs of relief.
Oh, really? How so?
Well, it's thanks to those lower mortgage rates. The average 30-year fixed contract rate, reported by the Mortgage Bankers Association, it dipped a significant 10 basis points down to 6.39%. That's actually its lowest level since October 2024.
Okay, that is lower.
And what's really fascinating is that this drop immediately triggered a massive spike, 29.7% in mortgage applications.
Wow, nearly 30%.
Yeah. And refinancing activity surged by an astounding 57.7%. Refis now account for like 60% of all applications. This isn't just a number, right? It could actually be a significant leading indicator for future consumer spending and overall economic activity. Lower housing costs, free up disposable income for a lot of households.
Absolutely. Something positive to watch there.
Yeah.
Okay, let's move across the pond to EMEA. The Stoxx 600 was flat overall, but you mentioned the FTSE 100 in London nudged up. What were the specific drivers there, and how did that UK price data complicate things for the Bank of England?
Right, so London's FTSE 100 did manage a slight rise, about 0.14%. It was notably boosted by strong performances from specific names like the luxury goods maker Burberry and automaker Aston Martin. However, the backdrop for the UK is, well, quite nuanced. Inflation remains stubbornly sticky at 3.8% year over year.
Still high.
Still pretty high. And this persistent inflation is creating a real dilemma for the Bank of England. It's fueling speculation that they might actually delay any rate cuts in their monetary policy meeting today.
So diverging from the Fed, potentially.
Exactly, a sharp contrast with the Fed's recent move. This divergence really highlights the very different economic pressures facing major global economies right now.
Yeah, definitely. Okay, and finally, let's look at the Gulf and APAC regions. We know the Gulf central banks matched the Fed. But what about Asia? Hong Kong rallied on property hopes while Japan slipped. What's the context there?
Right. So as we discussed, the Gulf central banks acted in precise unison with the Fed, mainly to protect their currency pegs, a crucial stabilizing move for them. Over in Asia, Hong Kong's Hang Seng Index jumped a notable 1.78% yesterday. That rally was largely driven by renewed optimism over potential property sector support measures coming out of Beijing. That could provide a much-needed boost to the local economy there.
Okay, hopes for stimulus.
Pretty much. Meanwhile, Japanese equities saw some profit-taking. The Nikkei 225 fell 0.25%. This was likely just investors locking in some gains after a strong run and also maybe positioning cautiously ahead of today's Bank of Japan meeting. Markets will be looking closely for any hints on future policy there. Mainland Chinese markets were closed for a holiday, just to note, so that created a bit of a data vacuum for that specific region yesterday.
Right, okay. Good wrap-up of the regions. So as we wrap up this deep dive, let's turn our attention to what's on the risk radar and the watch list for the coming days. What should we, and you listening, be keeping our eyes on?
Okay, first up, central banks again. All eyes are firmly fixed on today's Bank of England decision. We'll be scrutinizing any hawkish color, any signs of a more aggressive stance coming out of their monetary policy summary. That could challenge the current market pricing for an easy path of rate cuts, especially given that sticky UK inflation we just talked about.
Right, could upset the apple cart a bit.
Potentially, yes. Second, in the energy markets, we need to watch for follow-through on that massive EIA crude draw. Specifically, monitor the refined product balances. Remember, gasoline stocks were down, but distillates were up. And crucially, watch the sustainability of those U.S. crude exports. These factors are going to significantly affect global supply dynamics and, of course, prices in the short to medium term.
Got it. Energy balance is key.
Third, on the liquidity and volatility front. The VIX, the market's fear gauge, it remains pretty subdued, down at 16.36. This often suggests a degree of market complacency, maybe. Therefore, any unexpected data surprise, good or bad, could reprice risk asymmetrically, meaning sharp, maybe disproportionate moves. We should closely monitor cross-asset correlations, how different assets move together or apart, particularly as we head into options expiration events, which can sometimes amplify volatility due to complex hedging flows.
Right, complacency can be dangerous.
It certainly can. And finally, what would fundamentally change our current market view? Well, a stronger than expected labor or inflation print. Think about today's U.S. jobless claims or tomorrow's Eurozone CPI. If those come in hot, that could re-steepen real yields, bond yields adjusted for inflation, and maybe rekindle dollar strength. That kind of data would significantly shift the current market narrative.
Okay.
It could genuinely challenge the sort of dovish sentiment that followed the Fed's cut and force a real rethinking of current market expectations.
A lot hinges on the upcoming data then. Okay,
Yeah.
so maybe a final thought to leave our listeners with.
Yeah, well, given all the mixed signals we've discussed today, a dovish Fed cut, but a pretty cautious market reaction, those surging U.S. mortgage applications against sticky U.K. inflation, strong crude draws amidst broader macro concerns. What does all this suggest about the underlying economic resilience versus ongoing systemic vulnerabilities. And maybe more practically for you listening, how might today's Bank of England decision and the upcoming data clarify the picture for your specific portfolio or business strategy? Something to think about.
Definitely food for thought. Thanks for joining us, everyone, on this deep dive into yesterday's market movements. We hope this briefing has given you the facts and the insights you need to stay well informed and navigate this financial landscape. This update is powered by NextSite, transforming open source signals into strategy with the Site Connect OSINT platform. You can learn more at www.next-site.com. And please subscribe on YouTube and Spotify. Like, share, or maybe comment with the one macro chart you're watching most closely today.